If you look at the S&P or NASDAQ over the past 6 months, you might think the stock market's rallying. But I'm going to show you some data that shows why the stock market's actually near 52-week lows. What I'm going to show you might shock you. So let's get into it. If you look at a chart of the NASDAQ represented here by the QQQ, it looks like the stock market's been absolutely rallying over the past 6 months from about the end of December through today. And a lot of people have come to me and said, Scott, the stock market's absolutely rallying. It must be bullish. I'm just going to buy a whole bunch of stocks. But I want you to remember, if you're old enough to have traded back in this time period, the time period of March 2021 till the end of 2021. It was a very interesting time period where most of the stocks that retail investors held onto were down between 60 to 90% by the end of 2021. Yet the stock market indices continued to go up, and in fact, topped out at all-time highs in December of 2021. And it was one of the greatest disconnects for retail investors in recent history. And today, shockingly, we're in the exact same boat that we were in during 2021. But this time around, the stocks that retail investors are holding for the most part are the mega cap tech stocks: Nvidia, Apple, Microsoft, Amazon, Alphabet. And for people who are holding these mega cap tech stocks, it certainly feels like the stock market is rallying. Many of these stocks have doubled over the past 6 months, or at the very least are up between 50 and 100%. And this has had a great impact on the market indices, which have also rallied over the past 6 months. Taking a look at the weekly chart on the NASDAQ, we can see how the NASDAQ over the past 6 months has recovered more than half of the losses from 2022. And the same is true on the S&P 500, which has also recovered more than half of the losses from 2022. So I can certainly understand why people think the stock market is rallying. Because if you just look at the market indices, that is the Dow, the NASDAQ, and the S&P, it looks like the whole stock market is up massively. Yet, there are some very perplexing things that are going to show you why this actually is not the case. And in fact, if you look at another market indice, the Russell 2000, that is not rallying. In fact, the Russell 2000 is extremely bearish and near 52-week lows. So what's going on? Why is the NASDAQ and S&P up over 50% of the losses from 2022, yet the Russell is near 52-week lows? Seems like a big disconnect. Well, the problem ultimately lies in how these market indices are calculated. And to help explain what's going on, let's take a look at the CNN Fear and Greed Index. This is essentially an index that shows how bullish or bearish market participants are, and it's defined in terms of greed for bullishness or fear for bearishness. Currently, you can see how the index is at greed level, a 67 out of 100. And if you look at the S&P 500 market momentum, that is how much it's rising or falling from the 125-day moving average, it's certainly very bullish. In fact, CNN lists this at extreme greed. So if the market momentum of the S&P and the NASDAQ are at extreme greed or extreme bullishness, why is the overall fear and greed index only the greed stage and just a little bit above neutral? Well, that's where, when we start to dig a little bit deeper into what goes into the quote-unquote stock market, things start to become a little bit more clear. You see, when you're looking at an index or an indice like the NASDAQ 100 encompasses 100 stocks. Yet, of the stocks listed on the major exchanges, New York Stock Exchange and NASDAQ alone, there are over 8,000 stocks in the actual stock market. And of those over 8,000 stocks in the stock market, only 100 make up the NASDAQ 100. The S&P 500 fares a little bit better, at least it encompasses 500 of the over 8,000 stocks. But it's not until you get to a much broader market index like the Russell 2000, which encompasses 2,000 of the 8,000 stocks, that you start to get a clearer picture of how the stock market is actually performing. Yet, even if we only look at the S&P 500, we start to understand a little bit better about the issues with this index, and we start to understand a little bit better why the stock market is not rallying, even though the S&P 500 is up massively. If we look at the stocks that are listed on the New York Stock Exchange, the number of stocks hitting new 52-week highs versus the number of stocks hitting new 52-week lows is actually negative. And what that means is there are more stocks hitting new 52-week lows than there are stocks hitting new 52-week highs. Well, that's pretty shocking, given the fact that the market is up so much. I would think that all stocks were approaching new 52-week highs. It probably shocks a lot of people. It might even shock you to understand that more stocks are hitting new 52-week lows than are hitting new 52-week highs. Because the market indices, from very face value, don't really paint that picture. So to find out the truth that more stocks are going down than stocks are going up, pretty shocking. But let's dig a little bit deeper. If we look at stock market breadth, which is the volume or number of shares on the New York Stock Exchange that are rising versus the number of shares that are falling in any given day, this has been dropping. And that drop shows bearishness because it shows that the number of shares that are rising versus the number of shares falling is declining and is actually quite low at only about 600 of the over 8,000 stocks in the market. And that's why the CNN Fear and Greed Index lists the stock market breadth as fear or bearish. So if the number of stocks that are rising is in decline and more stocks are hitting new 52-week lows than 52-week highs, how is it possible for the S&P and the NASDAQ to be rallying? Well, it all comes down to how these indices or indexes are actually calculated. And the major problem with these indexes is that they're weighted, meaning only a few stocks make up the majority of the weights in the indexes. And with the weighting as it is, if just a few stocks go up, the majority of the stocks could go down, and yet the market could still be up. Let's take a look at the NASDAQ 100 as an example. If you look at just the top 5 companies in the NASDAQ 100, which are Microsoft, Apple, Amazon, Nvidia, and Alphabet or Google, those 5 companies alone make up 46% of the NASDAQ 100. That's right, 46% of the NASDAQ 100 is made up of just 5 companies, while the remaining 95 companies make up the remaining 54%. What that means is that if those 5 companies rise, the other 95 companies could fall. But if just 5 rise, the NASDAQ will rise. And it doesn't get much better when you look at the S&P 500. In the S&P 500, those same 5 companies, Apple, Microsoft, Amazon, Nvidia, and Alphabet, make up 25% of the S&P 500. 5 companies make up 25% of the S&P 500, leaving the other 495 companies to fight over the remaining 75% of the index. And this is the problem. If those 5 mega cap tech stocks rise, the S&P and the NASDAQ rise, even if the other 8,000 stocks in the stock market fall. And that is exactly what has been happening over the past 6 months. If we look at Apple, it is near a 52-week high. Microsoft, also near a 52-week high. Nvidia, also near a 52-week high. And this is the problem. Those 5 stocks, which make up half of the NASDAQ and 25% of the S&P 500, those 5 stocks have been rising. And because those 5 stocks are rallying, the stock market indices, the S&P and the NASDAQ, are also rallying. But the fact is, 60% of the NASDAQ stocks are trading below their 200-day moving averages. 60% of the stocks in the NASDAQ are still bearish and falling. But because 5 of the mega cap tech stocks have risen, the indices are up. So it appears at first glance, if you just look at the S&P and the NASDAQ, that the stock market is rallying. But once you understand that it's actually only 5 stocks of the over 8,000 in the market that are rallying, and the other 8,000 are either trading flat or going down, suddenly you start to understand that no, the stock market is not rallying, only 5 stocks are. And yes, there's a few others here and there that are going up, especially stocks that institutional investors load up on when they're fearful of an upcoming recession. One of those would be Walmart. Another example would be McDonald's. Those stocks very often rally as investors become fearful of an upcoming US recession. And what ultimately ends up happening is exactly what happened in 2021 and into 2022. In 2021, the 5 major mega cap stocks rallied. From March of 2021 through December of 2021, those 5 stocks went up, even though a lot of stocks fell. Most stocks fell. And most of the stocks that retail investors were currently holding back in 2021, they were down between 60 and 90%, while the 5 mega cap stocks continued to go up. And this sort of discrepancy eventually corrects itself. And we saw that in 2022, when those mega cap tech stocks finally started selling off. And when they did, they brought the stock market indices, the S&P and the NASDAQ, down with them. And over the past 6 months, as those 5 stocks have rallied, they brought the indices, the S&P and the NASDAQ, up with them. But there are signs that those 5 mega cap tech stocks are topping out. And one of the biggest signs, are PE ratios, or price to earnings ratios. And this is essentially a measurement of the stock price compared to the earnings. Now, a lot of new investors might say that PE ratios don't matter. And a lot of new investors were saying that back in early 2021, as PE ratios were running well over 100, in some cases over 500, and in rare cases even over 1,000. And a lot of new investors at that time thought that PE ratios didn't matter anymore. And they had a big wake-up call when those stocks finally started selling off and their portfolios were down between 60 and 90%. The reason I'm presenting all of this to you is I don't want you to suffer from the same wake-up call when the situation finally fixes itself. If you jumped into those mega cap tech stocks, congratulations. Now take your profits before the market corrects. What am I talking about? Well, let's take a look at Apple as an example. The top bars here, TTM net EPS, this is essentially the earnings over the past few quarters. And what you can see over the past 4 quarters is a decline in earnings. Yet, even as Apple's earnings have declined, the stock price has rallied. And this has caused the PE ratio, the stock price compared to the earnings ratio, to go up as well. And excluding that one weird period during the COVID pandemic, if you exclude that one really weird time during the COVID pandemic, Apple's PE ratio is currently the highest it has been in 25 years. And every single time Apple's PE ratio rises to this level, the stock tops out and Apple falls. And if you think Apple's PE ratio of 30 is high, Nvidia has a PE ratio of 180 and Amazon has a PE ratio of 260. This is unsustainable. You can think of a PE ratio as the number of years of earnings it would take for you to make up your investment. If you, just as an example, if you were to buy Nvidia stock and their earnings did not increase at all, let's just say they traded flat, that would mean that it would take you 180 years to break even on your investments. If you were to buy Amazon stock and the earnings did not increase and Amazon traded flat, earnings were flat, it would take you 260 years to break even on your investments. And that is why PE ratios are so important, is because eventually institutional traders look at those PE ratios and they say, this is unsustainable. They start selling the stock. And when they start selling the stock price goes down. And that causes more sellers and more sellers and more sellers until retail investors are in the exact same boat they were in 2022, where their entire portfolio is down between 60 and 90%. I don't want you to fall into that same trap. I don't want you to fall into the trap of thinking that PE ratios don't matter and that stocks are just going to keep going up forever. That's not the way the stock market works. It would be really nice if it did, but it just doesn't. Reality is, stocks can only hold on to these extremely elevated PE ratios for so long before they eventually top out and we get a rug pull and the stocks crash. So just know that most stocks in the stock market are not going up. Only 5 are. 5 big ones that control 50% of the NASDAQ and 25% of the S&P 500. And those 5 mega cap tech stocks are now extremely overvalued. And the rug will get pulled. And when it does, the stock market will fall. Now, I understand that if you look at the technicals, if you look at the market psychology, it's very, very greedy right now. And there's an old saying, don't fight the trend. The trend is your friend. But a lot of people forget the second part of that saying, and that is, the trend is your friend until it's not. Because trends don't last forever, and trends eventually reverse. So just be careful. I know the stock market is bullish right now, but there's a lot, just about anything, from a black swan event to market news, that could cause the stock market to fall suddenly and shockingly. Now, let's get into some of the market news this week that could move the stock market and could possibly trigger a stock market fall. Things you need to know about so that you're prepared, so you don't lose a ton of money if one of these events does in fact happen. When we look at this week's major U.S. economic news and Fed speakers, we have a lot of Fed speakers speaking. And lately, the Fed speakers have been quite bullish, and it's looking more and more likely like we're going to get another interest rate hike at the June FOMC meeting. So just be aware of that once the market starts pricing in another rate hike, that's going to push the stock market down. In addition, at 2 p.m. Eastern Time on Wednesday, or about 2 hours before the market closes, we get the minutes from the Fed's May FOMC meeting. And sometimes these are a nothing burger and the stock market ignores it, but sometimes there are some shocking revelations in there that cause the stock market to absolutely rally or causes the stock market to completely sell off. So just be aware that these are coming out at 2 p.m. Eastern Time on Wednesday and could trigger massive movement in the stock market when these come out. And then finally on Friday, we have the PCE, or Personal Consumption Expenditures Index, which is the Federal Reserve's preferred measure of inflation. And this is the index that the Federal Reserve is going to look at in trying to determine whether to raise rates again in June or to pause. And the PCE is expected to come in flat over the month prior. So April is expected to come in exactly the same as March came in. So we'll have to see if that's actually the case. Any shock here? If it's lower than expected, the stock market could rally. If it's higher than expected, the stock market could sell off. In addition, we also have news of the debt limit, which is causing the stock market to move as well. Now, you and I both know that the debt limit will get raised, but there's always that little tiny risk that this time is different and the stock market ends up selling off because the debt limit does not get raised for whatever reason. I mean, it always gets raised, but just the possibility that it might not is causing the stock market to fluctuate pretty wildly. And you just need to understand and follow up with the news that's coming out on this, because any news of a possible deal between Democrats and Republicans will cause the stock market to rally like it did on Thursday. And any news of a possible pause in negotiations or things just not working out could cause the stock market to sell off. And it could be very, very volatile. One day at 2% down and the next day 2% up. So just keep your eye on any news of these debt limit talks, because this is a pretty major market mover short term, even though we all know that eventually they're going to come up with a deal. And even though the stock market was down a little bit on Friday over talks of negotiations pausing, Biden and McCarthy are going to meet on Monday to try to avoid this looming debt default. And as negotiations resume, this could help push the stock market back up again. Keep in mind that a possible debt default is just 11 days away. Now, if for some reason the U.S. did default for the first time in U.S. history, default could lead to an economic downturn as bad as the Great Recession, with 8 million Americans losing their jobs and the stock market's value falling by 45%. Of course, that's worst case scenario. It's never happened in the U.S. in history, but just the fact that it's possible is the reason why the stock market will start to sell off if it looks like negotiations are breaking down, because investors start to get fearful that, hey, maybe I should just sell now just in case we do get that 45% drop, even though the odds of that are extremely low, but never zero. And Biden said on Sunday that he thinks an agreement can be reached with Republicans, but it's not certain. President Biden also said on Sunday that if a deal could not be reached, he's going to look at possibly doing an executive order to raise the debt limit ceiling. He has mentioned the 14th Amendment to the U.S. Constitution, but most people think that's just not possible. And you also need to keep your eye out for the regional banking crisis that continues to this day. It is not resolved. And Janet Yellen said that more bank mergers are going to be necessary in order to shore up the U.S. banking system. That means more bank collapses. Any more bank collapses that we do get are going to cause the stock market to fall again. And in other signs that the banks continue to be in trouble, U.S. bank deposits continue to decline in the latest Fed data. Keep in mind, it was a bank run. It was people pulling money out of the U.S. banking system that caused regional banks to collapse in the first place. And unfortunately, the latest Fed data shows that people continue to pull money out of the U.S. banking system, which will eventually cause more banks to collapse. And to prove to you that banks are not okay, even some of the larger banks, Charles Schwab is rushing to get a $2.5 billion debt offering out in an effort to shore up their balance sheet. So keep your ears out for any news of any more additional possible bank collapses, because if we do get any, that will also cause the stock market to fall. Now, if you want to know what we're doing and how we're making money through all of these ups and downs in the market and basically what's been going on, I wanted to give you some really good news, because if you've been thinking about joining the coaching program, but you thought maybe you just couldn't afford it, I have some really good news. We are bringing back monthly memberships. The old VIP monthly membership, it's back. So once again, after 6 months of not having any monthly slots open, I finally have some room for a few monthly slots in the VIP coaching program. If you want to get back into the coaching program, or if you just felt like you couldn't afford the annual or lifetime price and you want to pay monthly, you can now do so. All you have to do is schedule a call with the onboarding specialist, and he will get you into the program at the monthly rate. And you can schedule a call with him at weprofitdayandnight.com. It's weprofitdayandnight.com to get back into the VIP coaching program for a monthly rate instead of the annual or lifetime. Now, if you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed the videos I posted last week, make sure you watch the last video I posted here.